everybody, happy end of year. I'm going to give you some donation information and a ton of retirement information. So welcome back. This is our end of year, although I'll do one next week too. So not totally end of year, but let's talk about what you can do in the next week. You have a week left. So one of the huge things that we can do obviously is donation. So yay, donate. You can donate all year long, but a lot of people at the end of the year go, oh no, I forgot to donate, so I need to do that now. Your donations count as long as they're made by December 31st at midnight, prior to that, okay? So you have two types of donations. You have cash and non-cash. Cash donations are cash, check, credit, PayPal, Venmo, Apple Pay, any way that you choose to give a charity money, something of monetary value. It's called a cash donation, whether or not it's physical cash. The other type is a non-cash donation, which is stuff. So when you donate stuff, clothing, household items, whatever, to Goodwill, Salvation Army, Paralyzed Veterans, whatever that charity may be. Now, a huge thing you need to remember is no matter the donation, please get a receipt. A lot of the places where you donate stuff will give you a blank receipt. In that receipt, you need to value the items that you donated. They're not going to do it for you. They don't have time to do that. So basically, a lot of them will have websites or web pages that give a valuation guide. So it'll say something like, oh, a shirt is worth $2. And in that case, even if the shirt still has a tag on it for how much you paid for it and it was not $2, they can't resell it at a thrift store for what you paid for it. So it's still going to be valued at whatever the thrift store can sell it for. Okay? Next, self-employed donations do not count as a business expense. They count when you're self-employed. All of your business stuff goes on your personal return. So on your personal return, any donations that the business made are going to go to the itemized deductions, your individual itemized deductions. Okay, so keep that in mind. That may determine how you donate, where you donate, how much you donate, all of that. But it's something that you need to know, because I think a lot of people think just because they're in business, it becomes a business expense, and that's not the case when you're self-employed. So please keep that in mind. Now, I did a video previously on how to find out if the charity that you're donating to is legitimate. So please go back and watch that video. I did it for Giving Tuesday, but it counts for all year round, just like this video counts for all year round too. But just please check and make sure that who you're donating to is a legitimate charity. It's very important for everybody that the charities that are charities are actually getting the money. All right, so that's a biggie. So keep that in mind. Go watch that video any time of year. Now, we're going to talk about retirement contributions. This is a great little mini tutorial on retirement contributions, all right? There are really two things that we're going to be talking about, the 401k and the IRA. The 401k is through your employer if you're employed. The IRA is an individual retirement account. It's not through your employer typically. It's individual, which means you set it up through your bank or some other financial institution. They both have contribution limits. So the 401k for 2023, the contribution limit is $22,500 if you're under 50. If you're 50 or older, they call it a catch-up. So instead of a $22,500 limit, it's going to become $30,000. Now, the good thing about 401ks is because it's through work, you don't have to do anything. You set your contribution limit. It can either be a dollar amount or a percentage. Most employers will match a certain percentage. Usually it's around 3%, some more, some less. But that's free money to you. So keep that in mind. If you can at least put in as much as they match, that's free money. And the IRA. $6,500 limit for 2023, or if you're 50 or older, it's no longer a $6,500 limit, it's a $7,500 limit. So a lot smaller than the 401k, but also more work because you have to keep track of what you're putting in there, and then you have to let us know what you've put in there because we don't get anything for that. Your 401k is listed for us on your W-2, so we know how much you put in. And also, when you put $100 into a 401k, it's pre-tax, so you don't actually lose $100 out of your paycheck. If you put into an IRA, you're putting it after you get paid, so you do lose $100 out of your bank account. So there's a little bit of a difference there in how you need to think about that. And again, these are for traditional, which I'm going to get into. Now, the contributions for a 401k, because it's through work, the contributions end December 31st, and then the year starts all over. For an IRA, the contributions don't end. You can still make contributions until tax day, which in this case is April 15th of 2024. Okay, now there are two types of both. There are traditional and there are Roth. Now, the traditional basically decreases your taxes now, all right? It gives you the tax benefit now. It reduces your taxable income, which, like I was saying for the 401k, it reduces that taxable income before your paycheck even comes, okay? So that's one way to look at it. Do you want to lose $100 out of your paycheck? Yes or no? So that can determine 401k, that can determine Roth, that can also determine 401k or IRA. So the traditional gives you the tax benefit now. The Roth, when you don't get a decrease at all in your taxable income, but when you retire, it's essentially not taxed. So do you want to deal with it now or do you want to deal with it later? If you want to deal with it now, that would be a Roth. If you want to deal with it later, because it becomes completely taxable at that point, that would be traditional. The theory is when you're older, you're going to be theoretically in a different income tax bracket, right? So if you're in a higher income tax bracket now, you want to do traditional because when you're retired, you'll be in a lower income tax bracket. And the Roth would be vice versa. The Roth is if you're younger and you don't have a huge income right now, theoretically you're paying a small tax on it now so that you don't pay a larger tax later. But also you don't have to deal with it later. So some people may decide just to do a Roth just because they don't want to have to worry about it later. It's totally up to you. Either way works fine. Now for the 401k, everything we talk about having to do with contributions, it also applies to 457s, 403bs, and the thrift savings plans for federal employees. All right, so what if I wanted to do a 401k and an IRA? Can I do that? Can I do both? Well, here's the thing also. If you are eligible to participate in the retirement plan for your work, even if you don't, that little box on your W-2 gets checked. And these contribution limits will apply to you, even if you're not putting anything into the 401k. So in order to get the full IRA, traditional IRA deduction, you have to, as single or head of household, make less than $73,000. Married filing joint, if one of you is eligible for a retirement plan at work, you guys have to make less than $116,000. And if both of you are eligible, you have to make less than $218,000. If you're married filing separate, if you're filing married filing separate, you have to make less than $10,000. So again, I'm going to show you back to these contribution limits. You may want to talk to your tax person and you may want to think about it yourself, but typically maxing out your 401k is going to be more beneficial than trying to split everything between a 401k and an IRA. So that's very important to think about too. Now, can I contribute to a 401k and a Roth IRA? So remember, you don't get the tax benefit for a Roth IRA. And if something just says 401k or IRA, it means it's traditional. If it says Roth in front of it, it indicates a Roth. But if it doesn't have anything else, if it just says 401k or it just says IRA, it means it's traditional. So if I have a traditional 401k and I want to put money into a Roth IRA, there are limits for my contribution to if I can do that full $6,500. Okay, so if I'm single or head of household, I have to make less than $138,000 to contribute the full IRA amount. If I'm married filing joint, I have to make less than $218,000. And if I'm married filing separate, I have to make less than $10,000. And that's just to make the full IRA contribution. Now, one more thing I want to mention about this IRA contribution limit, that $6,500 or $7,500 for catch-up, that's total for all of your IRAs. So you could have 5 IRAs, but the total contributions between all 5 of those in total cannot be more than the contribution limit. Okay, it's not per IRA, it's in total. So that's really important to remember too. All right, now, breakdown. It's the end of the year. What can I do? You can make donations. Yay! You can possibly increase your 401k contribution, and you can make an IRA contribution. Now for your 401k contribution, it depends on your company, your HR, whatever, because we have less than a week. It's really not even a full week because there's going to be days off, holiday days off, so nobody will be in the office. If you're getting a bonus, like a year-end bonus, you may be able to put that towards your 401k. It just depends on your company. So just trying to throw some things out there that you can do for end of year that can help you with taxes. I hope that helps, and have a great holiday season, and I'll see you next week. Thanks. Have a great day.